All right, let's dive in. Have you ever wondered how a company goes from just being a cool idea to becoming this massive corporation we all know? Well, a massive piece of that puzzle is raising money. Today, we're going to follow the entire journey of an investment, right from that first little spark of an idea all the way to it being traded out on the open market. Let's break it all down.
So, let's start with the big question. You see a company on the news. They're building a new factory, launching some game-changing new tech, or expanding across the globe. But where does all that money, we're talking millions, sometimes billions of dollars, actually come from? It's not like that cash just magically appears, right? Well, the answer is something called a financial instrument. Don't let the fancy name fool you. At its core, it's really just a formal contract. Think of it like a special tool. It's how a company can package up a little piece of its future and sell it to investors who are willing to give them cash for it today. These instruments are pretty much the engine that makes the whole financial system run.
And that takes us right back to the very beginning of the story, the spark. See, every single financial instrument is born out of a really simple need. A company has a great idea, a project they want to launch, but they just don't have the cash on hand to make it happen. And that moment, right there, is where an idea starts its journey to becoming something you can actually invest in.
Okay, so this diagram shows you the whole cycle perfectly. You've got investors on one side, and their cash flows into companies to get these projects off the ground. Now, if those projects are a success, they start making profits. Some of that profit gets put back into the company for more growth, some goes to taxes, and the rest? It flows right back to the original investors. It's this give and take that really powers our economy.
Now, to make all this happen, the financial world is basically split into two big arenas. First, you have the primary market. This is where those financial instruments are born, where they're created and sold for the very first time. This is how the company actually gets the money. Then you have the secondary market. This is where those same instruments get bought and sold over and over again between investors. Think of places like the New York Stock Exchange or the NASDAQ. That's the secondary market in action.
So let's zoom in on that launch pad, the primary market. This is such a critical moment. It's where a financial instrument officially comes into existence and gets introduced to the whole world. And the most famous event that happens here is, of course, the IPO, the initial public offering. You've definitely heard this term thrown around. This is that huge moment when a private company decides to go public by selling shares, little pieces of ownership, to you, me, and everyone else for the very first time. It's a total game changer for a company.
But a company can't just, toss its shares out there and hope for the best. They hire a specialist, an investment banker called an underwriter, and their job is absolutely crucial. First, they go on what's called a roadshow, pitching the company to big-time investors to see who's interested. Then, based on that feedback, they have to set the initial price for the stock. This is a super high-stakes balancing act. Price it too high, nobody buys. Too low, and you leave money on the table. Finally, they use their massive network to sell that first big batch of securities.
Okay, so the launch is complete, the company has its cash, but the story is not even close to being over. Now that security, whether it's a stock or a bond, begins a whole new life out on the open market.
And that's the secondary market we talked about. The company itself isn't really involved in these day-to-day trades anymore. This is where all of us, from individual investors to giant pension funds, buy and sell those securities from each other. And this brings up a really important concept, liquidity. The secondary market provides liquidity, which is just a fancy way of saying it gives you the ability to sell your investment and turn it back into cash easily.
So we know how these things get made and where they're traded, but what are they really? Well, it turns out most financial instruments come in two basic flavors, and it all boils down to one simple question. Are you an owner or are you a lender?
On one side, you've got ownership. When you buy a stock, that's what you're doing. You're buying a tiny piece of that company. These are called equity securities. On the other side, you're not buying a piece of the company, you're just lending it money. The classic example here is a bond. The company is basically taking out a loan from you and promising to pay you back with interest. We call these fixed income securities. So it's pretty simple. You're either an owner or a lender.
Now, this is where it gets really interesting, because each of those choices comes with a totally different set of trade-offs. If you're an owner, a shareholder, you get some control. You can vote for the board of directors, and you have a claim on the company's future profits. But that potential for a huge return comes with high risk. If the company goes bankrupt, the shareholders are the last ones in line to get paid. But if you're a lender, a bondholder, you get zero control, and your return is capped. The big upside, your risk is way lower. In a bankruptcy, you get paid back before any of the shareholders do.
Let's look at how this split actually works. In this example, you can see the shareholders might put up half the money, but in doing that, they're shouldering 75% of the risk. Now, why would they do that? Because they're chasing 80% of the potential profits, and they get 95% of the control. The lenders, the debt holders, they put up the other half of the cash, but for way less risk and a much smaller but more predictable return and pretty much no control at all.
Of course, it's not just stocks and bonds. The financial world has a whole extended toolkit full of more specialized instruments. Let's take a quick look at a couple of other important ones.
So first up, we have money market instruments. The best way to think about these is like the cash equivalents of the investing world. They're all very short-term, very low-risk forms of debt. You've got things like T-bills from the government, commercial paper from big companies, or CDs from banks. Their job isn't to make you rich, it's all about safety and stability. And then you get into the more complex world of derivatives. The key thing to remember here is that their value is derived from something else, like a stock or a barrel of oil. A futures contract, for instance, is a binding deal to buy or sell something at a future date for a price you lock in today. You have to do it. An option, on the other hand, gives you the right, but not the obligation, to buy or sell. And that little difference is everything. It's the choice between you must and you can.
And really, that brings us to the most important takeaway from all of this. Every one of these instruments, a stock, a bond, an option, it's just a tool. Each one is designed for a very specific job. One is built for ownership and high growth potential. Another is built for stability and income. And others are for complex strategies to manage risk. So the real question isn't which one is best. The question is, which one is the right tool for the financial goal you're trying to achieve?